Well, hey folks, this is Sunday evening. Let's have a look at the markets. I put a video up this morning, so go and have a look at that one. That's called My Sticky Notes. And I'll link to that at the end of this video so you can see my thoughts on the dollar and commodities and gold and various things. Just a sort of a rambling phone recorded video, but I've given you some background on what I'm about to show you here today. So let's start off with the dollar index. And you can see on Friday, along with a drop in the majors, the euro, the pound, Canadian dollar, Australian dollar, etc., the dollar index rallied quite beautifully. And we've rallied up into these moving averages. We've closed conclusively above this downward trend line, above the 50-day moving average, and we're just touching the 100-day moving average on the dollar index. And if we have a look a little closer, you can see we've broken above sort of the most immediate resistance level here at around 102.40. We're now at 102.70. So it all looks pretty good. And look at the shape of the candlestick on Friday. You can see it's a shaven head candle. But we've only just sort of reached this previous resistance level here on the previous swing high. So we'll have to watch to see how this reacts. I expect that we'll get a retracement of the dollar index, perhaps down to the 50-day moving average, which is at around 102.50, and perhaps down as far as halfway down through this bullish candle, or both of these bullish candles put together, which would place our support levels at 102.50, perhaps halfway down here, which is about 102.30, and it's also the top of that previous breakout area. Or if we take these two candles combined, and they're roughly the same size, would take us back down to the top side of this downward sloping trend line, which will now act as a support. If we have a look at this on a weekly chart, perhaps it's easier to see, and there's the weekly candle from last week. So we'd expect in any normal healthy rally for this to retrace no more than 50% of the way down through this very bullish candle. You can have a look at that very quickly by putting in Fibonacci level from the top to the bottom. And you can see the 50% level is somewhere around about 101.85 to 102. So somewhere around about 102, let's say. And any one of these Fibonacci levels could act as support for a continued move higher. So that's the dollar index, and it all looks quite good for the dollar to continue its rally, and it falls in line with what I discussed in the previous video, which I recorded today by cell phone camera. So now that we've looked at the dollar index, let's look at the euro and the pound. You can see the euro has formed two bearish daily candles, but we've fallen down into the support level where this green line is, and that's at around 108.30. What I expect on Monday and going into the Asian session tonight is that with this momentum, we'll probably reach down to 108.30, maybe 108.20. You know, like the 80 numbers and the 20 numbers, and then perhaps a bounce back to recover some of this overextension. And those levels, once again, similar to the Fibonacci levels that we drew on the dollar index, could be Fibonacci retracements, let's say from 108, let's call it 108.30, if we get down there first and then bounce up. And then the first target for a retracement would be about 109.30. So we could get a 100 pip retracement once we touch this low, potentially at 108.30. So my strategy is to look for selling opportunities at around about 109.30, perhaps 109.20. Whenever we get 30s and 50s and 70s, I always like to round them off to the 20s and the 80s. So I'd say 109.20 and then a continued move down. And I'd expect the euro to continue moving down lower as the dollar strengthens, with a target initially of around 105.50. And then maybe, just maybe, if the dollar does continue to show strength and resilience, we could get a move down to the 200-day moving average on the euro, and that's at around 104.50. But they would have to break through these support levels here at 105.50. So overall, looking to sell euro into rallies with a first target of about 105.50, second target of 104.50, and possibly even much lower than that. But it all depends on how the dollar behaves in the coming weeks and months. And we know how higgledy-piggledy these markets are at the moment. And one needs to expect any potential outcome is possible. So at the moment, it all looks pretty good for dollar strength, euro weakness. Let's have a look at the pound. We've got the pound weekly chart on here. It's interesting that we've had this big bearish weekly candle on the pound. We've only fallen back down to support though. This is a really important support level at 124.35 or 25, somewhere around there. You can see it's a horizontal line going back some period, and it was a massive resistance level towards the end of 2022. So we've just fallen down to the top of that level. One might be tempted to think that this is far down as the pound's likely to go and that we're going to see further strength. And at face value, that doesn't look like a bad assessment. But overall, remember, my general thesis and the overall sort of framework and tapestry within which I'm sort of weaving these individual currencies is that of dollar strength. So in line with the euro and the pound and the Aussie dollar, a Canadian, all the other ones against the US dollar, I expect that the pound will continue to move further down into some of these support levels, possibly targeting 1.1850 or that sort of region. Last week's candle was a bearish engulfing candle, so that all looks good from a short-term perspective, but we do have the support that we've just fallen down to right here. If we have a look at the daily chart on the pound, you can see we've got this topping pattern where we started to sell. We got a big bearish candle on Thursday, another slightly smaller bearish candle on Friday, but a shaven bottom almost in both cases, and that momentum is probably going to take the pound down further. We've also broken down through a short-term trend line, and we've got various targets beneath us of these moving averages, the 50, the 100, and the 200 way down there. And my eventual target on the pound is around 1.1850. Bear in mind that the drop in the pound, these two candles here, Thursday and Friday, took place after an interest rate hike in the UK of 0.25%, plus very hawkish talk by the Bank of England concerning future rate hike possibilities. So all in all, if the pound was going to rally, it should have done so after that Bank of England announcement and after the hawkish comments in the subsequent conference. But the pound did not rally. In fact, it showed considerable weakness as the dollar showed considerable strength at the same time. That gives me reason to believe within that framework that I outlined in the previous video that we've got further downside on the pound, and we're heading down towards perhaps 1.23 and then 1.22 and eventually over a period of time down to 1.1850. That's all going to take some time. It's not going to be a straight line. And there are going to be bounces, retracements, side periods, etc., as is normal in this market. But overall, we want to look to sell the pound into rallies as we begin to move lower. Bear in mind, this all takes into consideration the overall idea that we're going to see some dollar strength in the coming weeks and months. If that thesis is wrong, of course, then the pound will find some support either here or slightly lower, and then begin to rally back up to this high at 1.2650, and then potentially higher and further up into maybe even somewhere in the 1.34 region. So we're going to have to keep a careful eye on how the dollar is faring up against the major currencies. We're going to have to be nimble and flexible in our trading and be prepared for every eventuality. I don't really want to say too much more on the major pairs because they'll all fall pretty much in line with the dollar and whatever effect that has on the major currencies, including the pound and the euro. So we can consider that the Canadian dollar, the Australian dollar, and the Swiss franc might all follow suit. There's one pair I particularly want to pay attention to, and that's the dollar Swiss franc. So let's have a look at that one. And we're long on this currency pair too. The reason I like this pair, if we are going to see dollar strength, is because the interest rate differential between the Swiss franc and the US dollar is the largest between any of the European currencies. And although we've seen the Swiss franc strengthen considerably over the recent period, that's due, I think, again to a sort of a flight to safety type of thing. And it's even possible that there's quite a lot of Russian and Ukraine money that's flowed into Switzerland. I don't know. Perhaps that's a conspiracy theory. But we've seen the Swiss franc strengthen quite a lot in the last couple of years leading up to and during this war between Russia and Ukraine. You can see where we are on the charts on Swiss franc right now, right at the lows of 2021, the dollar Swiss franc. So I kind of like this because the carry trade makes sense. If we're going to be buying dollars against the Swiss franc, we've got the biggest interest rate differential, and there's plenty of upside for this very oversold pair to move towards. And I'm hoping for this pair to move up to somewhere around 0.95. We're currently at 0.89. So there's probably a 600 pip upside for this pair into this area here, which is crucial because if I draw a line across there, you can see it's a clear support and resistance level. It's been support there, resistance here, support, resistance there. It's also where the 200-day moving average currently is. And it's also somewhere around the 50% retracement of this move from the highs down to these lows. So in that region there, in this sort of, I don't know, orange-pink zone, is a pretty good area for retracement, somewhere between the 38 and the 50% retracement level, probably slap bang in the middle of that where this horizontal line of support and resistance is, and that's somewhere around 0.9450, 60, somewhere in that region. So that's one of my favorite trades at the moment when we're talking about dollar strength, simply because of the carry trade, the oversold nature of this chart. And I think the ongoing concern really simply of Switzerland being right in the middle of Europe, which is basically in a potential war zone right now, potentially spreading out beyond the borders of Ukraine. Let's hope that never ever happens. I'm going to switch across to the yen pairs very quickly. I think I might cover this in a separate video, but basically I think there's room for the yen to strengthen against all the major currencies. And here I've got the US dollar yen, the euro yen, the Australian dollar yen, and the Canadian dollar yen. We're short the euro yen at the moment. We reached a potential resistance double top area, this green line. That goes back to the support tendrils that we talked about in one of the previous videos. It's also a resistance line here, and we got to there. We poked up through it. There's potential for us to move up to 153.80, which is the 78 Fibonacci retracement of the move from the highs to these lows. But this level at 150-ish, just ahead of that, provides a pretty crucial resistance level. If we have a look at what happened on the weekly chart, we got a rejection from there, poked through, perhaps just the algorithms to clear out a few stop losses, some of the funds fiddling around in that area. Often you'll get a poke through key resistance levels in order to make space, pick up liquidity, clear out the market hands a little bit, and then a move back down, providing a false break higher. That's what it looks like on the weekly chart. We go across to the daily chart, and you'll see what we often see, a sudden rush up to the resistance area, which acts as a price magnet, breakthrough there, petrifying all the short hands, taking out a lot of stop losses, and then promptly reversing with this dark cloud cover candle, followed by a break back and close beneath the support with a shaven bottom candle, and then a continuation lower. That's a classic sort of fake out, breakout at resistance, a prompt reversal, and a move back down. We're short on the euro yen as well, and that's a good example of how I expect the major currencies to trade against the dollar yen. We saw some strength in the dollar yen, along with overall dollar strength on Friday, just bouncing off that trend line and off these moving averages. So we'll allow for a test of this top again with the 200-day moving averages and this horizontal line. Perhaps a little poke through there, similar to what we saw on the euro yen, and then a move down, eventually breaking down through this rising trend line, through this red support line, and through these moving averages in order to continue on downwards. That black line there you can see is a really powerful head and shoulders type resistance level. You may have to just poke up through there a few times, perhaps into some of these levels here, around about 140, somewhere in that region there, where those little spikes are in this daily chart. So that sort of price level there, if we look at where it is at the moment, just poking up into that level above there. But with a bit of luck, hopefully we won't get as high as this resistance line, and we'll move up perhaps just a little higher early next week, and then begin to move down, eventually breaking down through all of these different supports, which are proving to be quite tough at the moment, but I think we could see some progress down through them into next week. So overall, I'm not going to go into all the yen pairs simply because there's no time, but I think we're looking to sell all of these. We're already short euro yen. We're looking at US dollar, Japanese yen at some stage. We did sell Australian dollar yen during last week. Canadian dollar yen we haven't yet looked at again, but that's going to come onto the menu sometime during the week. I think we could just get another retest of that 200-day moving average. Let's just have a closer look. And yeah, so we might just get a little bit more faffing around in this region where we are at the moment. But eventually, again, I think we'll get a move down through these moving averages and this rising trend line, which I'm going to put in right now. And that's the trend line that we need to break along with those moving averages. And we should then see the Canadian dollar yen begin to move down to retest the lows at around about 95 to 94, and then a further move lower after that. So I'm going to very briefly cover commodities. We've got Bitcoin here, we've got gold, we've got natural gas, oil, we've got uranium stocks, URA, we've got the uranium ETF, URA, and sugar. Basically, I'm just going to say what we're doing here. Bitcoin, I'm looking to sell into rallies up to this level here, 27,192. The reason is because we've got this beautiful pattern that's formed on the chart, head and shoulders pattern. We failed at this resistance level here, just above 30,000. We've broken down through this rising channel line, back inside the channel. We've broken through this red support line. We now need to retest it from underneath convincingly. Perhaps just poke through it again up to about 27,300, maybe 27,200, and then move down eventually into the 22,500 level, and then down to this rising channel line at the bottom here, which would take us closer to 20,000. Our strategy on gold is what I've been repeating for a long time. I think eventually we're going to break down through this sort of rising purple trend line, move back down into support. I think as the dollar strengthens, we're going to see some commodities come off, including gold and silver and sugar, and perhaps things like soya and wheat, and as I mentioned in the last video, orange juice and coffee and stuff like that. And I think gold's going to have to just come in a little bit. I don't know. Maybe we'll find support where we are at the moment, and we'll break up through that all-time high, 2075. But I think there's room for this to come back down and to pick up some more strength a little bit lower down. And I think the lines on here are pretty clear. We've got this descending purple channel line, which will be first support, and then we can get down into some of these lower levels around about 1,900, 1,920. That's where the 38% Fibonacci level is, and this horizontal resistance line. And then below that, we've got the 50% Fibonacci level at around about 1850. And then at the extreme, we've got the support level here and a couple of other fibs down just around about the 1800 level. So I think we're probably going to get down into somewhere around 1920, 1930, 1940, where we'll start to look for opportunities to buy gold somewhere in this region here. I expect we might just see a breakdown through this little short-term trend line and down into some of these levels here. And I think this area where my cursor is right now is the perfect area where we've got a confluence of all sorts of things. The descending channel line, the horizontal line, the Fibonacci line, the moving average, that's the 100-period moving average, and so on. So in this zone here, where we've got this whole sort of consortium of support levels, looks pretty good to me. But we're going to have to allow for a breakdown further than that into the middle of this sort of battle zone here, right in the middle here. And that's all taking place around about 1820 to 1850. In this area here, between the 50% Fibonacci level and the 61.8% Fibonacci level, where the 200-day moving average will eventually be, and just sort of right in the middle of this messy zone here. But I think with a bit of luck, we won't get down that far. And this area here, which I mentioned earlier, around about 1900 and slightly above, is going to provide a good area to purchase gold. But like with the currencies and all the other things we're trading, in quite an uncertain, unpredictable, and somewhat volatile market, we're going to have to be flexible, nimble, and creative in the way we trade gold, as much as we're going to have to do the same on other instruments as well. So sugar, for those of you interested in trading sugar, it's not an awful lot of people, but some people are interested in it. I've already taken short positions on sugar against this red line here, and I'm looking for a move back down into some of these support areas. I think ultimately the goal there, though, will be somewhere around the 21 to 22 level on sugar. We're right now at about 26.2. So quite a decent pullback into this area where we see the sort of medium price sugar at around 20. I think I was referring to dollars earlier. It's actually cents per pound. So forgive me if I made an error previously. It's obviously cents per pound, not dollars per anything else. It's cents per pound. So looking for a big pullback on sugar down into some of these areas. And again, I mentioned commodities in my previous video. You can just watch that to see what my thoughts on commodities are. We're now looking for oil WTI to move back into this channel and eventually test this downward sloping trend line, this red line, at around about $80 by the time we get there. And we're now at just about $70. We did buy WTI a day earlier at about $71.50. We're now down at 70, so it's dropped off a little bit on Friday as the dollar rallied. But I expect that we'll find some support basically where we are at the moment, where this previous low is over here. That's where we are at the moment. If I draw another horizontal line there, you'll see how that looks. So where we are at the moment is that previous low, actually just slightly below it, but that's okay. So where we are at the moment is that previous low, and I'm looking for us to find support here. And then move up to test the underside of this channel, back into the channel, test the downward sloping trend line, and then test the upside of the channel. And perhaps with a bit of luck, we'll get a break above this channel top and then move up into around about the $90 region. I'm not going to talk about natural gas because I did a video on that yesterday, and I'll link that video to this one at the end, and you can go and have a look at my natural gas video. Did quite a lengthy video on natural gas. I looked at some of the charts and some of our strategy going forward. So it's best that you're going to have a look at that video because I'm not going to cover that here. And I think that's it really now. And just for interest's sake, for those of you who are trading or interested in the South African Rand, this is where we stand at the moment, with lights off 6 to 8 hours a day all over the country, and with South Africans potentially doing arms deals with Russia, with ships arriving in the docks down in Cape Town, loading up with arms, money changing hands and all that sort of thing. The American ambassador getting all upset about it and going live on TV, and all sorts of shenanigans going on. All of that has managed to drive the Rand to new all-time lows against the US dollar, and on Friday we touched 19 rands 52 to the dollar, against the previous all-time low of 1934. So a new record for the South African Rand, which was once trading not too long ago at about 5 Rand 50 to the dollar. We're at now 19 Rand 50. And then against the British pound, also approaching all-time lows against the pound. If I just scoot back on this chart a wee bit, you can see we broke the 2020 high. That's rands against the pound. We've got a little bit to go before we get to the 2016 high, which is at 25 rands 80. We're not far off. Right now, we're at 24 rands 30 to the great British pound. So for those of you who are living in South Africa but earning foreign currency, probably a bit of a short-term bonus, but just you wait until inflation and interest rates, government taxes and price gouging all begin to take more effect, and those gains in your overseas earnings aren't going to be worth as much as you thought they were. Let's have a look at the US stock markets. Now, I don't profess to have any opinion on which way these markets are going to go. So I don't really want to comment on these much, but all I can say is that we're continuing to look to sell into rallies. And these shorting opportunities need to be timed very carefully. So we're going to continue to short the market, but only after rallies into key levels and looking for short-term gains on those drops. So I think overall we could see NASDAQ and S&P moving up somewhat. I think the NASDAQ could rally up to this next resistance zone at around 13,700. We're at 13,300 right now. And it's even possible we could get higher than that, up into the 14,000s, I don't know. But overall, I do expect all of these US stock markets, including individual stock names, to collapse quite dramatically at some stage during this year. It's just the timing of it is really difficult. So our trading strategy on stocks is to wait for rallies into key levels, take short positions with tight stops and tight targets, and look to be flexible in and out of the market, particularly after the US Open, let's say an hour or two after the US Open, after the market's done a little bit of a rally and then starts to pull back. And that's the way we've been playing this overall. So allow for NASDAQ to get up to 13,700, perhaps 14,000. That's not out of the question. We have a look at S&P. We've got this brick wall above us, which I keep on referring to. Every time we touch it, we fall back down. But we did see some strength last week after that sort of rally off the bottom of this megaphone pattern. And then beneath us, we've got these three moving averages, the 50, the 100, and the 200, all beautifully and perfectly aligned, supporting the price. These are my Bob Marley lines. Don't worry about a thing. And above us, we've got the brick wall from Pink Floyd, which is preventing the price from moving higher. At some stage, one of these is going to give. We're either going to move higher or we're going to move lower. My first trading opportunity, however, will be at the top of this megaphone sometime during the week if we get to the top, or at the bottom of this megaphone sometime during the week if we get to the bottom. I'll be looking to buy the bottom of the megaphone or sell the top. Now, as the days progress, this megaphone is going to obviously expand outwards, and so these levels will change from day to day. But that's my overall strategy for S&P. I think this is going to be the easiest one to trade. We'll be selling at the top of the megaphone, buying at the bottom. And that's all I can say right now. In the longer term view, if we do manage to break through the top on S&P, then we have to allow for a move up to somewhere around about 4,300 and perhaps even slightly higher than that, about 4,400, something like that. And what's interesting is that you can see that these lines eventually start to cross this megaphone pattern. So at some stage we might get up there. It's going to be a few days into the future. But if we do rally up in the first few days of this coming week, we'll have broken through the tops and the highs of these previous rallies, hit the top of the megaphone, potentially formed a false break higher, something similar to what we saw in some of the currencies, that false break higher and then the collapse downwards, and we could see us just touching the top of that megaphone and moving down. And similarly, if we reach the bottom of the megaphone, I'm going to be looking to buy S&P. So I think it's going to be very much a day trading sort of mode that we'll be in the next few days, rather than swing trading or longer term buy and hold or sell and hold type positions on stocks. Same goes for individual stock names. We've been selling Nvidia, Apple, Microsoft, AMD, all at the tops of rallies. So far, we've had some pretty good trades, a few dollars here and there on the downside on each one of these names, and I think we'll continue to do so. After having taken some profits on a couple of these pairs, I'm particularly interested in these three at the bottom right now. That's Nvidia, Apple, and Microsoft, and I'm looking to sell any of these into rallies as we go forward. We're still holding short positions on NASDAQ, Nvidia, Microsoft, and Apple right now as I record this video. But generally, these are very overextended markets. This is Nvidia, looking to sell that. We've got this rising trend line, potentially very squonk head and shoulders pattern on Nvidia after a massive rally during this year from 109 up to 283. Ridiculously overbought, and we need Nvidia to move back down. We've also got a rising ascending sort of triangle on Nvidia, something like this. We've actually just broken down through the bottom of it. We'll see a similar picture on Apple if we have a look at the Apple chart. I've already got those lines drawn in there. Just selling every time we hit the top of this rising wedge pattern. But we're conscious of the fact that we've got resistance above us, this red line here on Apple. Apple's also very overbought. We're really not far from its all-time highs at all. And we've got this rising wedge pattern, which might eventually force us into a corner. And it's not beyond possibility that we could even get a brand new all-time high for Apple before we form a short to medium term top and Apple begins to move back down into some of these more realistic levels. So don't be surprised if Apple actually makes a new all-time high, and that could just be the signal and the trigger to put significant bets on the short side on Apple, and that's when we make a brand new high at the top of this rising wedge. So that's it overall, folks. I hope you've enjoyed that. And if you've enjoyed this video, please give it a thumbs up. And if you're new to the channel and you haven't subscribed yet and you want to see more of this sort of content, you can click the subscribe button as well. Take care, have a fantastic week, and I'll speak to you soon.